All right, so what I'm going to do is today, I'm going to go into the tax-free retirement account refresher. Some of you who are new, some of you are already in the team, but this will help everybody out. So what is a 401k? Is that right for you? So you are okay with if you're okay with the government taking a large portion of your retirement, high taxes, if you're okay with your retirement accounts being at a risk, the market crash equal to account crashes, if you're okay with IRS taking up to 40%. Now, I had a screenshot that I had from the IRS website. In 1980, the tax rate had gone all the way to 70%, guys. At 100,000 a year income, you were paying 64%. Over 200,000, you were paying about 70%. So we don't know what the future, holds for us. But if you're okay with today's rate, it's about 38% over 200,000. We round it off to 40 just to do the math easier, because you don't know even if it goes to 40, it's still pretty bad. Off your retirement account, if you die, which means the IRS actually is one of your heirs. They take 40% of your chunk. And now 401k is great if you're okay with no access to your retirement funds without paying high penalties. It's okay for you if you're okay with being required to report your retirement earnings to the IRS. So that's the other thing. A lot of people don't realize and don't know that you have to report your earnings, right? And any profits you have, you have to report them. So they keep a track of it. They want you to do the bookkeeping for them so they can track you when they go to collect it, right? TFRA is right for you. You don't want, if you don't want to pay taxes on growth or principal ever, this is 100% legal if your TFRA account is set up correctly and structured according to the IRS code 7702. You will hear this sentence a lot. And people who negate us or people who say, oh, it's only good if you set it up right. Well, the software, when you do the calculation and you do the application, is idiot proof. It does not let you do it wrong. When they talk about do it right or do it wrong, what they're talking about is if you don't MEC the policy. And MECing means a function where you cannot have more money put into an account than the death benefit. So the simple trick is you increase the monthly portion you're paying, increases the benefit, and you have more amount, more ceiling. So the MEC, what it does, it adds a ceiling to how much you can overfund the account. The only way the trick is to do it is increase your monthly contribution. It increases the limit for the MEC. So that's not even an issue if you're doing it correctly, okay? So your loved ones will not be taxed on the account if you die. If you like to make 30 to 40% more interest than with a regular bank account, TFR is good for you if you would like your account to be guaranteed with no risk of loss, even if the market crashes. So these are all the features and benefits that a TFRA gives you, right? Now, if you want your money to be liquid, all money put into any growth in your account is available. You can withdraw any amount at any time without any penalties, all the way up to where you shut the account down. Right? You don't want to report the earnings to the IRS. The IRS doesn't classify income as income inside this kind of an account. So legally, it isn't Uncle Sam's business. So this is where these accounts are shielded from lawsuits, liens, judgments, bankruptcy, and divorce, and they're not discoverable in a discovery when an attorney tries to discover how much money you have. That's why a lot of the rich and wealthy people sock away a lot of their overage and profits into these types of accounts. Many people wonder why their financial advisor never mentioned this before. First, most financial advisors can only sell what their management allows them to sell. So a lot of times when you say, oh, how come my fund manager didn't tell me? Well, first of all, they don't carry this product. Just like if we don't carry Allianz as a product, we don't sell that, right? And we don't get paid on it if we try to sell it. So the financial fund managers don't sell it because they are contracted with carriers that are more of a variable products. They don't deal with the fixed market, right? So you will hear that hey, why is my financial advisor never mentioned this? So just understand and tell them, hey, they can only sell what their company is contracted with and what they allow them to sell, right? Simple answer. So most financial advisors aren't aware of these accounts or how to set up one of these legally. Financial advisors are taught to utilize more robust growth methods that also have a much higher risk of loss. This is not the best retirement growth tool for all of those on a guaranteed income. Safety of principal, accessibility without penalty and taxation, right? So whenever you have somebody say, I'll ask my advisor, and you need to know all these like tips and bullet points that, hey, the advisors are not taught to do conservative accounts. They make percentages on the brokerage, whether the account loses money or gains money. So a lot of times when somebody has an advisor, what I tell them is like, hey, can you get the advisor on the phone with me? And 9 out of 10 times, the advisor is not available and they don't want to get on the phone with me. And I'm like, well, if this guy's looking after your $500,000, shouldn't he be available to you at your beck and call? And they're like, yeah, why not? I'm not sure. Or if they do get on, what I do is I simply ask them, okay, great. I know which years the market crashed. And I asked them, hey, in this year, this date, how did my Mr. Client's account did? And they're like, oh, it lost like 30% because they have to disclose it openly. And I'm like, okay, great, awesome. I said, and so that year, how much fees did you charge Mr. Jones here? And they're like, oh, well, our fees are standard and we charge 3% or 4%. And I'm like, oh, so you charge like 4% of the account, whether it's lost money or gained money. So yeah, well, our fees are fees. We have to pay for things. I'm like, okay, great. So you charge my client between $4,000 to $6,000 for the year to manage the money which you lost on when the dip happened. They're like, yes. I'm like, okay, great, awesome. That's all I wanted to know. Thank you, Mr. Jones. That's all I needed. And I said, we can hang up. Wow. So after we hang up and we come back, I asked Mr. Jones, so what do you think? It's like, whoa, I didn't know I paid like 4% fees on this account. And I'm like, well, you heard your advisor tell you you did pay and you lost 30%. So this is how I've always handled advisors. So don't get scared of an advisor. If somebody said I'm an advisor, tell them, no worries. I have an advisor too. His name is Raza Begg, and I'm going to put him on the Zoom with you. I've had a call with IRS tax auditor that works for the IRS, and we did his daughter's account after he heard this. I had a call with an IRS tax attorney, and he's like 63, and he's like, man, why didn't you tell me this before? I would have socked away all my money in this. Now I'm almost close to retirement. So I'm not scared of any professionals out there. If they are professionals like tax attorney, tax advisors, CPAs, I love talking to them because they already know of this stuff. And it's very easy for me to like show them the light. And they're like, wow, man, that's crazy. That's amazing. That's awesome. And they know they can pull it up and they can do their research. So the more educated a client is, I love closing those clients because they already know and they understand where I'm going. So always keep that in mind. The stronger and the more literate a person is in financial things, we can help them understand and get them introduced to this easier. Okay. We had an advisor. Who was that? Takesha. Your cousin. He's a financial, he's in the open variable market. He actually saw this and he's actually getting some done for his daughters. And actually he wants to join us as a professional team member as well. So, which is exciting. Now, is this thing new? Is this a new thing? That said, the TFR is not a new investment strategy. Accounts like these have been used by wealthy individuals and families for over 100 years to build, then pass on their fortunes in a legally tax-free environment. Many well-known celebrities and even former presidents have used this account to grow, protect their wealth completely tax-free. FDR used his whole life for the cash value. McCain, when he was running, he used his cash value account to take money out and fund his campaign. So if you really go back and look, read up on the history of who all used it, this has been around for a while, okay? Now, everyone needs a TFRA. Interesting fact, less than 0.7% of Americans have a TFRA account completely tax-free, while more than half the population will needlessly pay tens of thousands in taxes in their taxable 401k, IRA, or a similar tax-deferred retirement account. A TFRA account isn't just for the top 1%. Now, you do have to qualify, but the process isn't difficult, and you guys have seen that. But it's open to everybody now. It was restricted till about 1985, when it was only open for what's called qualified investors or $1 million net worth individuals, right? So like in oil and gas investments, you can just kind of say, hey, I want to get a share in an oil and gas well. No, you can't. You have to actually be a $1 million net worth individual to be able to get that, okay? So a TFRA used to be the same thing. It was not open to the public, okay? Now, I'm going to open it up for questions. I know that we have a lot of team